Greetings. This is, I believe, session 8 of these podcasts on craft beer finance. And what we want to do in this short podcast is introduce a profitability measure that overcomes some of the weaknesses that exist with the one we talked about in our last podcast, return on equity. The particular metric is going to be called return on invested capital. Still pretty straightforward to calculate, but uses different numbers from the balance sheet and income statement, and probably gives a more comprehensive look and a clearer picture of overall profitability of the organization. We call it ROIC, or return on invested capital, and we usually look at it before tax, meaning what we'll do is we'll look at profits before we pay any taxes. And why we do this is we want to overcome some weaknesses that return on equity has. Specifically, return on equity uses net income in its numerator, and net income is affected by both income taxes and the amount of interest that a company pays. So if you can assume that if you have two companies, both exactly the same, but one has more debt than the other, if they have the same profit before interest and taxes, each company, the one with more debt will have lower net income because of the interest they have to pay. And that might affect how good or how bad their return on equity looks. Second thing we like to look at is, instead of using net income, is by using EBIT, earnings before interest and taxes, in the numerator. It again gets back to this concept of really wanting to know operating profits. In other words, the profits from operations before worrying about paying back interest on the loans or by paying taxes to the government. In the denominator, return on equity, you use shareholders' equity as the number. And as we'll see throughout these podcasts, a majority of small businesses are financed not just through stock and profits kept in the business, but they also have debt financing, line of credit, short-term bank loans, notes payable, long-term bank loans, leases, all these different things. So the fact that when we do return on equity and we exclude debt from the calculation, we're excluding a huge portion of the invested capital in the company. So the formula for this measurement is simply taking EBIT, earnings before interest and taxes, and divide it by what we'll call invested capital. And invested capital, similar to what we've talked about before with the managerial balance sheet, is simply cash plus working capital requirement plus any net fixed assets. So it represents the investment in the assets of the company, net of any payables and other short-term liabilities. Something that we really like about return on invested capital, in addition to the reasons we discussed previously, is that you can then also break down or separate out the ROIC into components. So you can start with EBIT divided by invested capital, and then by introducing sales into the calculation, if you take EBIT divided by sales times sales divided by invested capital, you'll get a sense of what is driving or what's causing return on invested capital to increase or decrease. Is it simply because we're more profitable in relation to our sales? Or is it simply that when we look at sales divided by invested capital, we're more effective at measuring or working with and managing our assets in relation to the sales level? So using our craft beer company example, again, sales of $1 million, earnings before interest and taxes, in this case you can see is $240, earnings after taxes $100. So there's really quite a difference between operating profits, or EBIT, and EAT, earnings after taxes, primarily due to interest and also due to income expense. Also recall that the balance sheet for the company in 2014 had total assets of $1,210. From a standpoint of invested capital, we'll get to that in a second, but note that this company has a combination of both debt and equity in its balance sheet financing portion. You have equity of $550, short-term debt of $220, and long-term debt of $330. So we want to see how good this company's doing using operating profits and the entire invested capital, debt and equity, as components of the measure. Now, when we looked at return on equity, remember we used EAT divided by equity, and we came up with 18.2%. Again, we don't know if that's a really good one or a bad one, but we still have to say, at least we calculate it. However, when we introduce return on invested capital, EBIT divided by the invested capital, including the invested capital, both the debt and the equity, you'll notice that the operating profit divided by the invested capital comes out to 24%. So why the difference between the ROE of 18.2 and the pre-tax ROIC of 24%? Well, partly it's due to the fact that we aren't including taxes in ROIC, at least the way we're calculating it here. But secondly, that difference is heavily due to the use of debt in financing the business. So what we'll get to on our next podcast is what is the impact of using debt to leverage in the business, to finance the business, and what impact it has on profitability, especially in relation to return on invested capital.